Welcome back. I started a new stream hoping to save the chat from the last one. When there are interruptions or edits, you lose chat and you lose, well, I think it always seems like captions are working now, even if the connection breaks but not the chat. So let's see if I can preserve the chat. I checked it just now and it's not there, but it might show up later. So anyway, I started a new stream and I will go over time. So if you have to go somewhere, just get going. Don't worry about it. But I want to finish up so you have enough to work with. So people who have to leave, just come back and see the rest of the video. All right, so I just did a demonstration, and I guess it was not recorded. This would be for 3 variables. So here are the weighted returns for A, the weighted returns for B, and the weighted returns for an asset C. A, B, C there, and we do the matrix again, and considering the covariability of those returns in pairs, so A with A, B with B, and C with C, and then you see that you have to, when you combine A with B, you get this term, but that's the same as combining B with A, those covariable, that covariation. So there's 2 of those, and there's 2 terms for those, and there's 2 terms for those. So I'm not going to write it up, but you can see it's a pattern that you can exploit for n assets, as many as you want. And it's going to be the diagonal, where it's squared weight and squared variance for each. So if you have 3, you have 3 of those terms, and then you have to have each of the pairs, and there's 2 for each pair of assets. So it's a very long formula, but using Excel, it's quite easy. Okay, and there are programs that do this as well. Oh, I went out. Okay, so let's get back to it. So that's all that this means. It means make the matrix. That's what this means. So you can figure out for as many assets as you want. Okay, so people are still coming. All right, so combining A and B, we got that the expected return would be 6.5. If we were to, like on average, so thinking, oh, sorry, let me see. On average, the expected return is 6.5. If we just think of the weighted average of the variances, is much bigger than the variance of the portfolio combining and holding 2 assets at the same time. Okay, so this is like, this is actually me holding them, and this is me weighing out the average return or the average variance. This is like an average variance calculation. So if some people held A and some people held B, this would reflect on average the average variance. But this is what you actually get, so much smaller. This means that combining assets A and B into portfolio P, that's what that is, we eliminate some risk mainly due to the covariance term. This is known as diversification and is a strategy designed to reduce risk by spreading the portfolio across many investments. So this can be done, right? You could study, you can look at Again, for each asset, you can come up with a distribution, looking at historical returns, putting it together with future prospectus, looking at the industry, the sector, and then also looking at the state of the economy and predictions about the future state of the economy. And you can come up with these distributions. And with those distributions, you can calculate the mean and standard deviation of returns, weighted mean and standard deviation. And then you could look at combining them. You could think very carefully, oh, I want this one with this one. So what would be a set of negatively correlated assets? Can you guys give me an example? Somebody? What would be an example of negatively correlated assets? Oh, I feel like I lost the connection again. I think I lost the connection again. You guys there? It says excellent connection. Okay, so if you wanted to invest in gold companies, either extraction companies or in you want to invest in companies that invest in gold. So you can invest in gold funds or gold extractors or gold companies. And you could also invest in stock, right? So you could find that in general, we think when the economy does poorly, people move to gold. And however, that has not been the case. I'm not going to get into it right now because that's going to delay us. But right now, gold is not performing as well as it would have been predicted because of the existence of cryptocurrency. People are using cryptocurrency like Bitcoin and other currencies instead of gold, in the place of gold. And so, but there's still a lot of anticipation when the economy does poorly or there's uncertainty, people move to gold because historically they've moved to gold and it has longer, much longer, we're talking thousands of years track record that other assets just don't have, new companies and even cryptocurrency. So anyway, so yes, that's a good example. Companies in gold versus companies, other companies. Those would be negatively correlated. Another negatively correlated set of companies would be investing in construction. In construction companies and the tourism industry. So because seasonally construction, and I'm talking in the US because obviously here it's the same temperature, climate, so it's not a big deal. But in the US, construction companies operate more in the summer months, but people take vacations, in the cold climate, they take vacations a lot they do in the summer, but they do more in the winter, right? They travel abroad. So anyway, those could be negatively correlated as an example, taking advantage of the seasonality. All right, so what this uncovers for us is the difference between risk. There are the risks that can be diversified away, known as the, in different terminology, unsystematic, unique, or asset-specific risk. And then there's the risk that cannot be diversified away. that actually has something to do with, well, we'll talk about it. What does it have to do with? In general, a well-diversified portfolio can be created by randomly combining about 25 risky securities into a portfolio with little or no cost. What am I talking about? If you want to run an experiment, and financial economists have done this, where and here's an example, this paper, this is old and it's been redone, this has been repeated, to turn out similar results, similar findings, that if you just randomly pick assets, so you're not even looking at any kind of analysis like I suggested before to derive distributions and carefully pick securities considering past and future predicted performance, if you were to just randomly select them, so you could do that in a computer, you could do that by putting names on sheets of, on slips of paper in a hat and just picking, what would you see? Would you see any particular pattern? So this is what financial economists did. And so here is one example of an experiment that was conducted. So one asset was chosen among randomly selected. And then that was recorded like in Excel, right? So they put that information about the standard deviation. That's what we care about, is the standard deviation of return. So for that asset, for all the assets that they considered randomizing, they had information to calculate the mean and standard deviation of those assets. So they took that standard deviation, they put it in an Excel spreadsheet. And then they did that again, and they did it again. So repeat samples, they repeatedly randomized one asset at a time. And then they averaged all the standard deviations they collected on their spreadsheet. And they got 49.2%, just picking one asset at a time. Then they did, two assets. So they picked two assets at a time randomly, and then they did it again, and it did it again, and it did it again. And each time they calculated the standard deviation, just like we did, of the portfolio. And they had the standard deviation of the portfolio of 2, and then they did it again, randomized 2, get the standard deviation, randomized 2. So in repeated samples, the average of all those standard deviations is plotted here. Okay, so there's a pattern that unfolds. If they combine 10 in repeat samples and got the standard deviations of a portfolio of 10, and then average all the standard deviations, they got this number. And so it looked like the more assets chosen on average, the portfolio standard deviation went down. But they couldn't get it any more down than about 19%. After 25 assets being combined, randomly, completely randomly selected, they couldn't get it down. So there are many assumptions in this model, right? So they assume that adding more assets is not going to add more cost. I think that's what it says here, with little or no cost. So assuming low cost of combining assets, which is not necessarily the case, there is this pattern that emerges. And it shows that, and this is all I really want to get out of this, is I can't do that much, I can't do any better than this. I keep on adding and keep on adding, and I just did a break in the code. Even if you add 1,000 securities with no additional cost of putting 1,000 together, it does not reduce the risk. So what's going on? We're going to name this the risk that cannot be diversified away as non-diversifiable risk or systematic risk. And this is attributable to other factors, not the interrelationship or correlation between the assets, but it has to do with how they interrelate with the economy. So now I'm coming full circle with the statistics that we covered. Here is an example. This is a very simple example, so don't let it confuse you. It's very simple. All I have are 2 states of the world and 2 sets of returns. This should look familiar. Here's BCE, remember that company Bell Canada Enterprise stock returns, and this is the S&P 500, a proxy for returns on the market or market performance. So it looks like when the economy does well, BCE does well, and when the economy does poorly, BCE does poorly. So they're correlated positively. And if we're to calculate the sensitivity, a measure of relationship between the returns to the market and the returns to the stock, here is the plot. So I could plot my two values here. Now there's only two. And there must be more. There would be more around here, but I'm only dealing with two because what I want to demonstrate is we can calculate the correlation, assuming there's linearity, because that's what we have to do. Assume that there's a linear relationship between these variables. There's only two values to make it simple, so don't let it confuse you. Assume a linear relationship, then we should be able to estimate a line for prediction purposes, and the slope of that line can be calculated with change in y over change in x. So this should all look familiar and not intimidating because this is just a slope. And the reason it's in Greek letters is because this represents a distribution. Okay, so what do we see here? We have captured in doing this the slope relationship of how to get from one outcome to the other. And we actually find that the slope is 2.5. So it means when there's a change of a positive 1% in the market returns, the return to BC will change by 2.5%. So I'm just saying this is the slope, right? Because I have the change in x, which is the market, and I told you always, always, always we put x as the market returns, as the explanatory variable. And it explains, and that's how I've interpreted it, if there's a change of 1% in the market returns, then there's a 2.5% in BCE returns. And that sounds great when things are good, but it's risky because when things are bad and the market is in a downturn with returns of negative 1%, BCE returns are down negative 2.5%. Right, and then I just make a point here that if there's a negative correlation between the market and the returns, then the slope will be negative. In this case, it was positive. So this is coming full circle with everything I taught you. This was a very simple case, calculating the slope, and you can make the calculations yourself to convince yourself that's what it is. But usually we have much more points than just 2, right? We have more points than 2, but I just did it with 2. We have more points than 2, and then the line is only as good as the correlation coefficient, how close those points fit to the line. In this case, we assume linear, and we also assume a strong correlation to be able to interpret the slope. If there was a weak correlation, the slope is kind of not meaningful, right? Because you're not really going to use the line to make predictions if the correlation is poor. So what we have is a measure now of sensitivity of stocks returns to the returns on the market portfolio. We calculate the slope when you have more than 2 observations. More than 2 values or possible outcomes, let's say that. And so we use statistics to estimate the slope. We don't just do change in y over change in x. We use the statistics. So what is this again? I gave you these formulas. This is like b r sy over sx. Remember, the term risk as your mnemonic device to remember this formula so that it doesn't confuse you. And it is just R, because that is the symbol in Greek letters for the correlation. And this is SY because we put the stock on the y-axis and then we put the market on the x-axis. So that's all this is, which can also be written like this. This is the covariance spread out over the variance of the market returns. So it's a measure of how it's a fraction, right? Of the covariance of I's returns with the market spread out over the variance of the market returns, and it reflects the sensitivity of this asset's returns with market performance. This formula, the second formula, comes out of the fact that we know what the correlation is. The correlation is, remember, the standardized covariance. So I'm always appealing to the statistics notation you learned, and I'm just casting it in finance. Remember, this is just covariance of x with y. X is, well, it's backwards, but I is the y and this is the x, because I always put market on there. And then this is the assets standard deviation with the market standard deviation. So they are reversed, but it's okay. It's the same thing. It is the same thing. It's the same thing. So this is familiar to you. And next, it's 11:44. Am I going to get into Markowitz portfolio theory? I'm going to skip over this. This is where we're going to start next week. Now on the test, everything until Markowitz. I'm going to do Markowitz after the test. Okay, so this is for after the test. I'm not going to write it here because it'll confuse you. So I will talk about this after the test. Where I want to start is, I will explain all of that in a second. Okay, so this is what you learned. The capital asset pricing model is what you learned in 3106. And I won't backtrack, but I just want you to use it for the test. So CAPM is on the test, but not the portfolio market theory. Let's see. Yeah, I can do this. So and then next week I'm going to talk about Markowitz. That won't be on the test, but we'll talk about it. All right. And okay, I guess I have to start here. I guess I have to start back here. I'm going to skip that. I'm going to skip that. I don't know if I can skip this now that I think about it. Okay, I'm going to just touch this and go deeper next time. But what you need to know is we are going to combine stocks, okay? So I will just say, I will make a note here. You need the results, but we won't go into the depth of it. Okay, so we need the results. So we saw that combining stocks into portfolios can reduce the standard deviation, or the measure of risk. Covariance, or the correlation coefficient, makes this possible. The standard deviation of a portfolio, remember, is the square root of this long term, which we know where it comes from now. And also, depending on the information you're given, this allows me to write replacing this term with the correlation. So you could use this formula, this equation, or this equation, depending on the information you've been given, okay? Now I'm gonna, the notes use this relationship and consider two assets. And with those two assets, again, we repeat, calculating the expected return and the standard deviation, so you can check those. Verify these calculations. And then what's done here is what I'm going to talk about more later. What we do is combine assets. And it looks like there's a pattern depending on the correlation. And I use the extremes, perfectly negatively correlated, perfectly positively correlated, and no correlation. And these are the possible combinations depending on what fraction of investment you want to make in either asset. So here are three alternatives for the portfolio. I could put 75% in Y and 25% in X. So what I need to do is consider these portfolios relatively speaking. Going back for an instant to the returns, which one is the higher risk, higher return asset? Okay, so Y is the riskier one with the higher return. So it turns out more of Y will have more risk but higher return. More of Z will have, did I say X, Y? It's Z. Z will have less return and less risk. So Y is the riskier one with higher return, right? Y is the riskier one with higher return. So let's plot those. You can plot those in this space. You can put expected return of the portfolio here as a measure of return. And you can put the standard deviation of the portfolio here as a measure of risk. And so now I'm plotting the trade-off between risk and return. And I put Y here because this is the high risk, high return one. And again, I'll talk about the details of those calculations after the test. What I really want to do is the pattern and the result. Okay, so then this is low risk, low return. And what we're going to do is combine the assets in a portfolio. So what happens? If there's no correlation between Z and Y, then there's no advantage in terms of reducing the standard deviation. There's no advantage by adding Y. There's no advantage in making this lower. It just goes higher the more risky asset Y you put in. So these are all the possible combinations of X and Y. I mean Z and Y. If they're perfectly negatively correlated, you have this happen. What is this? This is an example of the diversification effect. This is the best you can do with the diversification effect. Look, your standard deviation is essentially 0, no risk. You can find a combination to reduce the risk to 0 if this was the case. Now, let me go back a step. Where are these correlations coming from? I'm just making them up because I'm trying to get a general pattern. So I'm making it up and I'm saying, imagine if you have perfect negative correlation. Imagine if you have no correlation. Imagine if you have using the same assets but with a different relationship. Just to show you, this rarely happens. You don't get perfectly negative correlation, right? But that's the extreme. This combination, so the combinations, what am I talking about combinations? What am I talking? I'm talking about the weighting. More of Y does this, reducing the risk completely. And then beyond this point, my risk goes up, but also my return goes up. Actually, it's going up all along. It's going up. It continues to go up with adding risk. So these are all the different combinations of more of Y in the portfolio, less of Z, more of Y. And this is 100% Y. It just becomes Y. And this one is 100% Z. So what I've done is this formula here. This is the formula I'm using to generate this graph, and I keep varying 3 variables, Y, XZ, and correlation. So those are the variables that I'm playing with to make that graph. And I'm plotting the standard deviation on the x-axis. With me, the 11 of you. So what I'm doing then is this outlines changing more Y, so Y goes up, and then to the ultimate where XY is. So here, let me add some more points. So here, the weight on Z is equal to 1, and the weight on Y is equal to 0. And here, the weight on Z is equal to 0, and the weight on Y is equal to 1. Just to be clear. And then everything in between is different. So wouldn't it be interesting to know this one? This one is called, this combination is known as the minimum variance portfolio, the MVP, the minimum variance portfolio. And it's the best you can do in terms of reducing your risk depending on the customer's or an individual's risk tolerance. They may be prepared to take on more risk for a higher rate of return, but this is the best you can do if you are risk averse. And so that's all for perfect negative correlation, there's a combination of Z and Y. In other words, the weights XZ and XY that will give you the minimum variance portfolio. So it would be really interesting to know XZ and XY for those. So we have so far discussed the perfect negative correlation would look like that. The zero correlation would look like this. And then correlation that is positive would just be one straight line. It's a linear combination of the returns of combining Z and Y. There's no diversification effect. If they're perfectly positively correlated, the negative, it's the negative correlation that creates this. So, what we see here are possible combinations, and in particular, there's a pattern, and most securities are going to fall on this green line, or this green curve. There's going to be a little bit of diversification. After a point, it just increases in risk and return in the combination of two assets. So it's always somewhere in between. So this pattern is what I'm interested in, the green curve, not the extremes right now. So this is the green curve. And again, over here, you can verify all these numbers. You can spend some time to verify these numbers. With the formulas that I pointed out on the previous page. Okay, so this pattern is a combination of risky assets, two risky assets. And it shows you the risk and return trade-off between them. So in the two asset case, what we have here is this pattern, and we have to mark the minimum variance portfolio. That is called MV here. And we need to discuss what's going on here, because here the portfolio will increase in return but decrease in risk. So actually, investors will prefer this combination to any of these, which makes these inefficient. We call these feasible because we can calculate all of these using the formula I gave you. We could calculate the weights that we would need to get these returns all along this line. So that's called the feasible set. But the efficient set, the only ones that are for a rational investor, that a rational investor would consider, are those along here from MV to Y. So this is a very important turning point right here. So you'd really want to find out what is the mix for these. Where this point here marks mostly Z, just to give you an example, 75% in Z and 25% in Y. And then all that information is plugged into this formula to find the standard deviation, and this formula to find the expected return. So these are the formula that are used to calculate expected return on that graph and standard deviation on that graph chart. So it's 12 o'clock. If you guys have to go. I'm just going to continue a few more minutes. Yeah, I'm going to continue and talk about where this brings me, so you guys can study. Okay, so what we're going to do next is combine more than two assets in a portfolio. So here we have just two, and it creates this eggshell type set of possible combinations for two assets, possible, weighted combinations of two assets. And I can consider another set of two at the same time, and another set of two, and another set of two. This is actually multi-dimensional. You can think about it, and what you want to achieve is combining more assets, right? The possibilities of having a portfolio with several assets. If that reduces my risk, why wouldn't I be interested in that? So you notice there's considering two at a time. I can smooth over generating this larger eggshell shape that touches each of, might touch more than two assets at a time, right? This might coincide with 3, 4, 5 assets in a portfolio. This one might coincide with 5, 6. So wherever it touches, this could touch two pairs at a time, like, I don't know. Anyway, just imagine. I'm not going to do anything precise here. So you can imagine that there can be eggshell shapes in here, but each point here represents a combination of more than two. Okay? But what we're interested in is the outside envelope of that. And this entire envelope here is called the feasible set with multiple assets, where still going from the minimum variance portfolio to the most risky asset constitutes the efficient frontier. So investors choose along this set of asset combinations. So we still have risk on this axis and return. Now what? So those are for the risky assets. Investors will choose, depending on their risk tolerance, which portfolio they like. Okay, these are all feasible, these are not, because for all of these, an investor can get a higher return with a lower risk. So they wouldn't pick any of these. This would be the one that they would pick when choosing between any of these. A rational investor is capable of making all these calculations and is aware of all this information. So they wouldn't pick any of these. They would start picking from MV to U. Now, there aren't just risky assets available for investors to put in their portfolio. But among the risky assets, investors are going to go on to, the goal would be to move up and to the left, okay? Because lower risk and higher return, that is what they want. And then that would create this envelope, and they'd have to choose along that curve. So it's important to identify which portfolios dominate other portfolios. And you do that again looking up and to the left, these are all the portfolios up here, any combinations up here in this quadrant are preferred or dominate the others. Other quadrants. If you had two assets, if you were considering two portfolios, let's say one here and one here though, and they were both on the same, of course you're going to pick this one over this one, right? Because this is lower return. If you had to compare low risk, I said the wrong term. This is low risk when I compare this to this. If I have an asset down or a combination down here and I'm comparing A to C, of course I'm going to pick A because even though the risk is the same, the return is higher. So I'm always picking A. A dominates the ones below it. So let me do this to demonstrate what I'm talking about. You can do this and see it creates an upper quadrant, and A dominates anything below. All right, so now I'm going to introduce the idea of having a portfolio with risky and risk-free asset, or yeah, it's going to be risky assets and then riskless or risk-free asset. And I introduced that by discussing short selling. I feel like I want to do this in the class next week, but okay, let's see. I'm debating. Okay, well, I'll just talk about it. All right. So, what is a short sell? Short selling is the sale of a security that the investor does not own. How does this happen? The investor makes an arrangement to borrow the security from a broker, and what he does with the security is sells it in the open market. He uses the proceeds for whatever, but at the end of the term of the loan, has to return that security, not the cash, has to return the security to the broker. So there's a risk here, right? That he has to have the funds to be able to buy back that stock at the prevailing prices in the future. So that creates uncertainty. At the initiation of the short sell, your only cash flow is the proceeds from selling security if you do this. To close the short, eventually you will have to buy the security back in order to return it to the broker. The cash flow, at the elimination of the short sell, your only cash flow is the price you have to pay for the security in the open market. So how does this pan out? So here's an example. A Treasury Bill is a zero coupon bond issued by the government with a face value of $100 and with a maturity no longer than 1 year. So this is a zero coupon. There's no coupons. Pure discount bond. If the yield on a 1-year T-bill is 5%, then its current price is $95.24. And we learned about that months ago. So these are the circumstances. A short sell is initiated when you borrow a 1-year T-bill from your broker and then you sell it. So you can get this in the market, $95.24 today. So you have this and you can do what you like with it. What we're going to do with it is put it towards buying risky securities, right? Because we're looking at the next best opportunity. So at the end of the year, you have to buy the T-bill back an instant before it matures in order to return it to the broker. The price you will have to pay for it, remember, is going to be the $100. That's the face value just before it matures. So what you've done is you have effectively borrowed $95.24 for 1 year, and then you've paid it back at $100. The interest rate is 5%. So you have that implicit 5% as a T-bill yield. So what we're going to do is use this idea. We create risk-free borrowing and lending, because I've just talked about borrowing. But you can also, this is borrowing, but you can also sell T-bills. You can short sell, and you can be on the other side as well. What this does for us is expands our efficient frontier beyond this set of multi-asset portfolios. We're still on the same standard deviation and expected return graph, and what I'm going to plot, what I'm adding is the risk-free asset here. This is the T-bill here. With a return of, in our example, the expected return was 5%, but I'm not going to say expected. What's going to happen is I'm going to use the notation RF, not with an E, because there's no variability, there's no risk, there's no volatility, there's no change. It's going to just be risk-free. So I'm going to write risk-free, and it's going to be, for example, in our example, RF was 5%. And the standard deviation of it is 0%. That's why it's right on the line here. So investors will look at investing in the risk-free T-bills and then consider risky securities. And the one that they're going, the market portfolio that they're going to choose is the one that's just tangent to this line. This is a linear combination created between the market portfolio that's selected, that's optimal, and risk-free asset. So an investment in the risk-free asset in the market portfolio creates this line. Here, we can create a portfolio between here and here by lending money. So here you're buying T-bills, and here you're short selling T-bills. So let me say that here. So without having a bank to consider, you've created risk-free borrowing and lending. So any combination in here, it's a linear combination of the risk-free asset and the market portfolio. And any combination beyond here is the market portfolio and short selling. And using the proceeds of the short sell, or the proceeds of borrowing the asset and then selling it, putting it towards the market portfolio to expand the portfolio returns. Yes, you still have risk, but if an individual is prepared to take on additional risk, they have the potential for those returns. All right, so what does this do? This creates the capital asset pricing model for us. All securities are in, these are the assumptions of the model. All securities are in the market portfolio. So you have all securities possible in the market, but maybe some are very small proportion, very close to zero in the portfolio, and then others are in higher proportion. But all the weights sum to 1, right, of all the assets in the market portfolio. All investors have M in their portfolio since they are all on the new efficient frontier called the capital market line. So they're investing in both RF and M by borrowing or lending. So what do we see? Investors are only concerned with the expected return and the standard deviation of the market portfolio and with the contribution of each security I to the market portfolio in terms of the systematic risk measured by beta and the contribution of expected return. This is what generates the capital asset pricing model. What this is, you can use this, I can interpret this as all investors invest in the risk-free asset. To invest in risky assets, they must be compensated. So the expected return must be improved, must be compensated for that risk. This is a measure of risk in relation to market returns, and they should be compensated for every unit of risk by this. What is this? This is called, well, you've seen this already. We made these calculations. This is the risk premium, but more particularly, let me make that premium, risk premium. In particular, this is called the market risk premium. This is the market risk premium. So this is what we calculated back when we were talking about risk and return in the other set of notes, where we were taking the returns to long-term corporate debt minus the risk-free rate and calculating the risk premium for different asset classes. Now I'm talking about the market risk premium. This is the expected return to the asset of portfolios recognized as the efficient preferred portfolio, and minus the base case where investors at least are investing, rational investors are investing in the risk-free asset. So this is called the capital asset pricing model because it does what? It helps me estimate It helps me estimate the return, the appropriate risk-adjusted rate of return. That's what I'm getting here. This is I. This is our I. So this is a way of calculating the expected rate of return. I'm going to add in the word required rate of return. Okay, so this is our way of getting an I for our asset. Beta can be calculated as that slope, either this way or this way, depending on the information you've been given. And keep in mind that the beta of the market is 1 because what does it mean? It's the sensitivity of market returns to market returns. That's how we interpret that. The beta of I is the sensitivity of beta I's returns to market returns. Now market returns are captured by that market portfolio. That was like representative of a market index. The basket or the portfolio that's used to track the market index. That's what our market portfolio was like. So this is 1 because this just means sensitivity of market returns to market returns. So that's just going to be 1 for 1. And you can verify making calculations. All right, so what do we do with this? I'm going to change the graph. I'm going to plot the risk as beta now and the return still as expected return, but notice it's not the portfolio, it's the asset I. And this is the risk on asset I. And what I've done is I create this new market line. This is called the security market line. And I have M here, the risk-free rate here, and I can imagine all possible combinations of risky and risk-free assets. Here I am lending, in other words, buying T-bills, and here I am short selling to extend the possible combinations. All right, so what I'm going to do is let you work with this, verify. So this should be review. If it's not, verify all these calculations, and then I'm going to pick up from there. I'm going to make sure I sent you enough notes to work on and practice. So this is what you're going to work on this week, is the capital asset market line, capital asset pricing model, and making these calculations, and I'll make more sense of it on in Friday's class. Okay? So yes, verify all these calculations. And we'll talk about it more. So for the 3 of you or 2 of you that are there, thanks for sticking around. But yeah, so work with this material, and I'm going to make sure I sent you enough handouts to practice. Okay? So keep in touch. If you have any questions, please let me know. We're going to talk even deeper about this material before the test. Okay, so have a good weekend. Have a restful yet productive weekend. Have a great day, Julian. Juan. Bye, Jose.